Y ahora sí le pido al equipo de producción que por favor nos ponga a Jay Pelosky, exactamente, que como ustedes saben es amigo de la tribuna, y Jay obviamente me hace que yo practique mi inglés, y creo que la primera pregunta que le vamos a hacer a Jay, aparte de darle las gracias porque está con nosotros, es ¿qué nos dice su bola de cristal de lo que puede estar pasando en todo este zaperoco, por decirlo así, desde el punto de vista de los aranceles? Jay, how are you? How you doing? Happy Friday. Thank you for coming.
Happy Friday.
And I think the first question to you is, okay, Jay, what do you think about these negotiations that just happened a few minutes ago, where President Trump is now again changing the rule on the spot, saying Canada goodbye, because I have some conspiracy theories that says that's a message not for Canada, but for the European Union, Japan, India, and a few others. And thank you for coming. Tell me, please.
Well, I think our view has been for some time that the way to invest in the age of Trump is to pay zero attention to what he says or what any of his team says, because as we've seen, and you're just talking about the latest example, it can change on a dime. So what we focus on is not what Trump says, but what he does. And all of what he's doing in the domestic space anyway, economically speaking, is trying to drive a massive tax cut through Congress. And so tariff revenues, Doge savings, all of this is meant in service of providing the space for tax cuts, which are problematic and struggling to get through Congress as we speak.
I see. And in other order of ideas, Jay, obviously you're absolutely right. I came from a country, and I don't want to compare President Trump with President Chavez in Venezuela, but we used to say the same: don't pay attention to what President Chavez says, pay attention to what he's doing and what he's really doing, aside what the team members of his administration might tell you he will do. In any case, the markets are on a bullish mode. And we don't think that this earthquake with the tariff will derail the fact that because of potential cuts on interest rate, they might be able to actually, up to some point, buy any dip. In your opinion, where do you think the second half of 2025 it might go? Because obviously 2025, the second half will start on Tuesday. And I have some people saying there is a lot of liquidity. It might be some cuts potentially, at least in September, if not July, and we're going to know the tariff pretty soon, by 4th of July. What do you think about that?
Well, our view has been for some time, for most of this year, that we are in the early stages of a secular leadership change in global equities away from the United States to the rest of the world. And that leadership change is going to be underpinned by a sustained period of capital repatriation out of the United States, back to Europe, back to Asia, back to emerging markets. And so our view has been and continues to be that one wants to be overweight non-US equities versus the US. This is a significant change given that since the bottom in the great financial crisis of 2009, the US and tech-led US equity markets have been the dominant winner by far. And yet this is changing. The first half of this year, non-US is outperforming the US by about 13 percentage points. The dollar is down roughly 10%. And we think the last week or so, with the Israeli and US attack on Iran, were very illuminating in this regard, because you had a crisis, a surprise crisis, a shooting war, and yet there was no bid for the dollar and no bid for treasuries. And so this suggests that the market is taking on board the idea that the US is no longer the fireman or the lender of last resort or the safe haven asset. That is no longer the case. And so even in a shooting war in the Middle East, there's no bid for the dollar or for US treasuries. And so as we look into the second half of the year, we're very overweight non-US equities across Europe, across Japan, emerging markets, including China in Latin America, and we're overweight commodities. We think that the setup here is very constructive for commodities to do well in the second half of the year. You have decent global growth. You have a weaker dollar, which helps because commodities are priced in dollars. You have a weak dollar allowing EM central banks to cut rates and not worry about their currency, which is, again, very, very unusual. And most importantly, I think, and I'm writing about this week and last week, you have Europe and Asia starting to make very big moves to support their currencies and compete with the dollar. So we're moving, in our view, towards what we call a tripolar world of regional currency blocks, with the euro being the currency for Europe, the Chinese yuan being the currency for China, and the US dollar being the currency for the Americas.
Listen, obviously you mentioned that the last time you were with us, and it's a pretty important theory with the tripolar world, and I think you're absolutely right. One of the other economists that we interviewed within the last 24 hours, one from Oxford Economics and another for the biggest and largest financial institution in Chile, were thinking that the exceptionalism of the US is not dead yet, just yet. And they think that if anything happened, the flight to quality will come. But I'm absolutely in the same bucket you are, because when we saw what happened with Iran versus Israel, you don't see a bit in the 10 years. That was a scary movie, because obviously you're right, money is not coming, and it might be some sort of repatriation, and obviously now that the dollar might go down, it will accelerate up to some point that, unless obviously there is something good that happened out of this tariff. Changing the topic, what do you think is basically this dilemma with the shadow Fed that President Trump might basically announce within the next few weeks? And I think that the timing, Jay, and I want your opinion on that, because obviously the market are buying the narrative today that is gone, that is what is called a lame duck, because obviously he didn't have the power he used to. And I think President Trump strategically with his team is waiting for anything that happened around July 30 on the decision for the Fed. But this is a very scary movie, because as you know, you try to be neutral between government and the Fed, and now we're seeing a potential replacement. And if they basically do that in the Congress, they might be able to pass that, and they're going to put someone extremely aligned with the government and extremely dovish. And that's a scary movie for the dollars, and I want your opinion on that, Jay, please.
Yeah, well, it's definitely not good for the dollar, and so you know, you see the dollar action hitting new 3-year lows yesterday when this idea first popped up. Look, again, it's just Trump being Trump. He can't help himself. He is a chaos agent, you know, an actor of uncertainty. And so he really can't help himself. That's just the way he operates. So, you know, the point is that the U.S. government under a Trump administration is a uncertainty factor. And typically when you have uncertainty factors, they get priced at a discount. So the imbalance is between the U.S. Financial asset space, equities, dollar, rates, are all priced at a premium, right? The S&P trades at 22 times earnings. Europe trades at 13 times earnings. China trades at 11, 12 times earnings. Emerging markets, 13 times earnings. U.S. trades at a massive premium, even though arguably it no longer deserves it. And that's why we think we're at the beginning of a secular, meaning multi-year change in leadership away from the U.S. So that multiple premium that the U.S. has gained over the last decade or more because of faster growth, because of better earnings, those things are going away, right? Post-COVID, the U.S. had the best growth of any major economy because it spent aggressively and built up fiscal deficits. It now no longer has that fiscal space. The fiscal space has migrated to Germany, which is spending massively on defense and infrastructure. It's migrated to China, which is spending aggressively on consumption. And so all these things are pointing one way, which is that you have a U.S. asset base priced at a premium, which it no longer deserves. And you can talk about politics not really impacting markets, but the reality is that U.S. growth is going to be subpar, right? Q1 growth in the U.S. was negative. Q2 is likely to be pretty nominal. Q2 earnings growth in the U.S. is forecast to be roughly 3%. And so that's okay. Single-digit growth is actually good for the U.S. in our view, but it's much smaller vis-a-vis the rest of the world than it used to be. So U.S. earnings growth is no longer much better than the rest of the world. So what's the reason for the premium valuation? And that's what I think markets are starting to recognize. And the point that we want to make is that the best environment for non-U.S. equities to outperform is when the U.S. is just going sideways, right? So when the S&P goes up 20%, nobody cares about the rest of the world. When the S&P goes down 20%, nobody wants to be in anything. So a U.S. that grows, earnings at 5-7% and gradually allows that premium multiple to deflate over time, not through price, is the best possible environment for non-U.S. equities to outperform. And that's kind of what we think we're getting. We're going to get single-digit earnings growth in the second half of the year out of the U.S. Stocks kind of meander around a little bit. And that gives the rest of the world an opportunity to catch a bid, because while the U.S. Goes back and forth in chaos and uncertainty, Europe is making a move for a single investment union. China is making a move to make the yuan more convertible. These are huge changes that will allow those parts of the world to start to capture some of that premium valuation that for the last 15 years has resided in the U.S.
Jay, I want to change the topic because you as an American and a seasoned, let's say, analyst of a lot of trends in the U.S., you probably have something to say when clients approach you with this type of questions. You've been seeing President Trump acting in the way he acts. You mentioned it right. He's chaotic. He basically wins over this chaos. Now today, the Supreme Court basically gave him a backup saying, listen, no, any other judge can derail your agenda. But one of the other things I'm concerned is about the Democratic Party. Why? This week, we got a strong indication that they are going extremely out of the center with the race in New York, with this new candidate, Mandani, that is far left. And one of the theories there is obviously that this tends to help the Republican Party at this point make things easier to see an after-Trump kind of a forecast. And as you know, I'm asking you that not because of the political aspect, but this agenda that he's putting together might have some sort of extension, taking into consideration that he cannot go by no means on a third mandate. We might be another Republican, because Democratic Party, I think, are going perhaps in the wrong direction. But I want your opinion, Jay, because have a lot of ramification on the economic side, please.
Well, that's we're getting into the realm of personal views versus professional views. So it's not, not a place I like to really travel. As a professional investor, one needs to stay focused on the professional side of things and try to leave the personal aside. However, since I am a New Yorker and I live in New York City, and therefore we're talking about why could it be our next mayor. Look, I think New York needs new leadership. The current mayor is dogged with corruption charges. Former Governor Cuomo stepped down due to his own personal issues, clearly not a candidate of the future. And so Representative Mamdani obviously spoke to a lot of people and generated a lot of enthusiasm, which I think is reflected in his victory. So going forward, the U.S. is confronted with this reality of federal government that is trying to jam through massive tax cuts for very wealthy individuals. Arguably, it's not the way the country should be going. economic policy in the U.S. is not being managed for success in this administration, in my view. If you look at the approach towards renewable energy, the U.S. is giving up on renewable energy.
Yes.
You know, Trump doesn't believe in wind power, solar power. He thinks EVs are, you know, not good. And so the U.S. is giving up on a critical function, which not only plays into the power issue, which plays into the AI issue, but arguably the learning from clean energy, and China is demonstrating this daily, the learnings, advanced manufacturing learnings from clean energy is being played into robotics and advanced manufacturing. It's playing into drones and military defense. And so arguably, you know, the U.S., as I said, this is our whole thesis. The U.S. under the Trump administration is going backwards. And the rest of the world, Europe and Asia, is recognizing a strategic opportunity that the Trump administration is giving them, and they are seizing it. And so when we think about the next 5 years, which is what we call our long frame outlook from 2025 to 2030, we believe the world is going to look very different in 2030 and not to the betterment of the United States.
Jay, I want to congratulate you because you're right. I throw you kind of a personal thing and you manage it super professional, but it's a hot topic. You can understand that everybody's on top of these things that actually have some sort of ramification. Obviously, we will see what happens within the next few years, and hopefully we have a better world, but I hear you. And obviously, it's a concern that we all have in the U.S. about the direction of the country. Not only that, in terms of the markets, it's extremely important to see the flow of the assets going into outside the U.S. You're absolutely right. So I'm going to tell the production team to bring you back. I love to speak with you from time to time. Have a happy Friday, and looking forward to speaking with you pretty soon. Take care, Jay.
Okay, take care. Have a great weekend. Thank you.